Hello, and welcome to Virtual Investor Conferences. My name is John Viglani on behalf of OTC Markets, as well as our co-host, KCSA Strategic Communications. We're very pleased you joined us for our next presentation from urban-gro. And before I introduce our speaker, a few points to note. If you're interested in scheduling a meeting with urban-gro, please click on the Meetings tab found on the left navigation bar. You'll be able to view the company's availability and submit a meeting request. Also, all of today's presentations will be recorded and available for 24/7 replay. At this point, I'm very pleased to welcome Brad Nattrass. He's the co-founder and chief executive officer of urban-gro, which trades on NASDAQ under the symbol UGRO. Welcome back, Brad.
Thank you, John. Good morning, good afternoon, and good evening, everyone. I'm Brad Nattrass. I'm the co-founder, chairman, and CEO of urban-gro, a professional services and design build firm that's focused on being the leader in providing solutions to the global controlled environment ag sector. We listed on the NASDAQ in February of 2021 with a $62 million raise, and we currently trade under the ticker symbol UGRO. I'm excited to share our story with you today and then set up some one-on-one meetings for us to meet up and talk further about any questions that you may have in the future. So with that, let's begin. First slide is safe harbor for you to review. In our 8th year, and supported by a board of directors that possess deep experience in finance, M&A, and global horticulture, by the end of the month, we'll have more than 150 employees, of which more than 100 make up our in-house professional services team, which is compiled of architects, interior designers, a full range of engineers, construction management related personnel, as well as horticulturists and plant scientists. Combined, our team has thousands of projects of experience, and we execute our offering in multiple business sectors, including CEA, both in cannabis and food, as well as commercial, which includes industrial and healthcare sectors. Our corporate office is in Lafayette, Colorado, and in total now we have 8 offices in the US, as well as 1 in Dordrecht, Netherlands. As for our key points of differentiation that provide our competitive advantage and set us apart, the first is the complete end-to-end set of services that we provide for our clients. All of our services are in-house, and with the acquisition of Emerald Construction Management in Q3 of this year, we go to market with full design capabilities as well. Taking it one step further, our value add within CEA is equipment specification, procurement, and integration. Our supply chain group has more than 40 vendor partners in categories such as lighting, environmental controls, mechanical systems, and benching solutions. And our internal sales engineers present the strength of each and come up with a holistic solution based upon our client's budget. The second advantage is our deep domain expertise in all sectors. Moreover, as the CEA sector is relatively new as it relates to growing cannabis indoors and food and vertical farms, our expertise is truly an asset that our clients find great value in. Whether they're building a cultivation facility or dispensary, an indoor ag vertical farm, or for one of our commercial clients, an MRI or manufacturing facility, our clients can come to us for the full design build of their plans or engage us with an a la carte just for a portion. Lastly, our business has been growing and maintaining. We finished 21 with revenues of 62 million and 2.7 million of adjusted EBITDA, and have just reported first half revenues of 37.4 million and EBITDA right around break even this year. This being said, and resulting from the industry pressures that are being experienced in the cannabis space right now, we've guided that this current quarter, which we'll report on November 10th, Q3, will be weak. However, it's going to serve as our trough quarter. Building on 22 million of backlog, which for urban-gro's signed contracts with our clients and deposits received, And combined with no debt and 23 million of cash entering Q3, we continue to be in a strong position to execute both our strategic and acquisition plans for the future. We'll not only finish the year strong, bolstered by our pipeline, we'll enter 2023 with phenomenal momentum. Further evidenced by a recent announcement of over $50 million in signed design build contracts in Q3, as well as our acquisition of the engineering firm DVO, our future is most definitely bright. I love this slide. I love this slide because we're truly experiencing it firsthand right now as our sector diversification is driving our growth right now. With the acquisitions of services companies that we've been making over the last 18 months, not only are we acquiring that expertise in CEA, we're also acquiring client contracts and the rapid expansion of our in-house team to meet the demand. But further, moreover, we've also been acquiring contracts in the non-CEA space, or what we refer to as the commercial sector, both industrial or healthcare. It's common knowledge that we're in the middle of a challenging time for the cannabis market, and this is mainly due to regulatory delays and decreased funding available to our clients. While we've remained very busy providing the architecture and engineering and design services for our cannabis clients, their CapEx expenditures, they've drastically declined, and also hence our weakened guide for Q3. While this is indeed putting a burden on our financial performance, the strong growth of our commercial sector clients in industrial and healthcare, it's providing solid results that we anticipate will bring us back to a cash flow positive position in the near future. Moreover, this strength is allowing us to keep hiring and cross-training our assets so we're ready for the anticipated cannabis market rebound in the first half of 2023. As interstate commerce is prohibited, as states award licenses, cultivation facilities and dispensaries, they're definitely going to be built out. And not only do we anticipate the delayed rulings in states like New York, New Jersey, Connecticut, Georgia, and Florida will begin making positive progress in the next 2 quarters, we do believe that the SAFE Act in one form or another will pass later this year, and this will in turn allow increased access to capital for our clients. So as a result of the diversification, when this happens, our in-house professional services team, our design build capabilities will be ready. Everybody will be ready for the great demand that we're anticipating so we can take advantage of the market and offer valuable packages to our clients. Diving a little deeper into our design build offering in the CEA space, in the span of time in which we recognize revenues in a project, this timeline defines our full turnkey design build model. Moreover, how our solutions extend for the life of the facility as we're involved throughout the entire process. Overall, we bring a single point of responsibility. After engaging our clients very early, 12, 18, sometimes 24 months before startup, we first focus on consultation and space planning, what our clients expect or desire from the facility, not just at startup, but 1 or 2 expansions into the future. We then move to architecture and engineering phases, which culminates with stamped construction documents, and the construction begins. When or while the facility is being built out, for CEA, we also then focus on cultivation design, the specification of environmental equipment systems, also the procurement and integration of those systems. And as mentioned earlier, we're equipment agnostic. We work very closely with the best horticulture equipment manufacturers in the world, and then come up with a holistic integration plan to integrate these systems into the facility based on clients' needs and preferences. Manufacturers continually evolve their technologies and also new entrants merge. So we take that pressure on ourselves to stay on top of trends so we can always have the best solutions available for our clients. Also, in the CEA space, once a facility is operational, we have a managed services division that's branded Grow Care, and we provide training, troubleshooting support, maintenance, and also remote monitoring of the facility and the equipment systems that we supply. Diving a little deeper into some real life examples, I'm going to walk through a couple of case studies, one in CEA and one in commercial. Starting with this CEA one, focusing on cannabis, it highlights the different stages in a typical client's project, from the concept to the build up. And while we have the capabilities to handle all of these stages in-house, we also work on a la carte model as well with our clients. So as you see in this slide on the left side, that's a concept. We've worked closely with the client to design the entire facility, both on the outside and the inside. We then put the construction management plan together, and the next picture shows some of the process or progress within a facility. All of this has been designed ahead of time by architects and engineers, and culminates with those stamped construction documents. From the benching systems in the middle, also lights, environmental controls, and mechanical systems as well. Nothing more rewarding than seeing the facility become a reality. And as I mentioned earlier, we also focus on the build of dispensaries as well. Our sweet spot for a design build project is facilities that have approximately 30 to 50,000 square feet of canopy. And these contracts, from a value standpoint, it really depends based upon the CapEx choices made. But we anticipate average project based upon that varying size will be about $30 to $50 million, inclusive of everything excluding the land and also the cannabis license cost as well. Further, from a revenue recognition standpoint, it will take place over phases, usually totaling 18 months, but depending on issues in supply chain and other factors, it can also extend up to 24 months. It really depends where the client's at in their process and the different critical control points along the way. Some clients will sign larger contracts up front, one of which was announced earlier this month, reflecting the over $50 million in design build contracts signed in Q3. And given the market conditions right now and the decrease in CapEx expenditures, what we're finding is clients are typically signing contracts for the full design portion of the facility, and then are pushing pause on the construction portion until the regulatory delays and funding is finalized. We currently have more than 24 projects in design stage, so indeed lots of positive momentum for the future of urban-gro. We're incredibly differentiated here, and as time to market is very valuable to our clients, having that single point of responsibility on a design build, our deep CEA expertise, the value add of our expertise on equipment integration, all of that combined, we estimate we can get our clients up and running about one harvest faster. And in a new market opening where the price of cannabis is typically at its highest, this strongly increases our clients' ROI. One closing thought on this case study: when the project's complete and the facility's operational, we don't leave. We stick around. We make sure there's no startup issues. If there is, we solve them. We also, with the Grow Care managed service program, we're there looking for a win-win. We're helping our train on the equipment systems, the staff, and helping remote monitor to make sure everything goes smooth. So also for us, we're front of mind when it's time for the next project. This second example it provides an overview of the services and solutions we provide to the commercial sector, and specifically our chosen sectors of industrial and healthcare. urban-gro continues to earn these engagements with legacy clients because of our track record of execution, that single point of responsibility, doing what we say, and our record of consistently meeting clients' unique expectations. As can be viewed in these pictures, we're working on design, we're working on architecture, we're also working on the full design build of other types of facilities, including healthcare, whether it be a larger facility or a smaller MRI facility, also industrial, consumer packaged goods facilities as well, and cooler systems. To demonstrate the synergies of our M&A plan, I'm going to focus on one of these long-term clients. It's a global CPG food beverage company that has worked with our construction management division for more than a decade. Post-acquisition, based on the strength of urban-gro's balance sheet as compared to the acquired company individually, the client began to increase the number of projects and the size of the projects, including the design build of a bottle molding facility, where over an estimated 8-month timeline, urban-gro will design, engineer, and then build out that facility. For me, the sector diversification is a key value for urban-gro, as it's driving our growth and it allows us to make the most efficient use of our assets. As mentioned earlier, we have a strong financial position, and our balance sheet provides us with this flexibility needed for continued growth. Our cash position entering Q3 is $23 million. And with our trough quarter that we just guided on in Q3, this will decrease to high teens entering the fourth quarter, but still a very strong cash position in a difficult time. As of today, we still maintain a $0 debt position. Forward looking a little bit with the recently announced acquisition of DVO, the Texas-based engineering firm, there will be a seller's note involved, payable over 4 quarters. But safeguarding our cash position is a priority. And these are very favorable terms for urban-gro, as the acquisition's positive cash flow, they're expected to cover most of these payments over the next 4 quarters. We have an incredibly clean cap table with only common stock, no preferred stock. And approximately 30% of our stock is held by insiders. From recent 13F filings, greater than 26% of our float is currently held by institutions. From a warrant standpoint, they're purely from the uplist to the NASDAQ, and the outstanding common share options, they've been issued to our board directors and our employees only, primarily for retention incentives. Also, nice to have 4 analysts covering the company now. They all have buy ratings and price targets that range from $6 to $12. After 7 straight positive adjusted EBITDA quarters, due to the cannabis sector macro environment as discussed earlier, we had our first negative quarter in Q2 this year. And although revenues are up more than 30% in Q2 versus Q2 21, we had negative adjusted EBITDA of $500,000. We've also guided on a negative adjusted EBITDA Q3 as well. But our backlog was $22 million entering Q3, and with the announcement that we've signed over $50 million in design build contracts in Q3, backlog entering Q4 is going to be materially higher as entering Q3. So our balance sheet is strong. In Q3, we guided that trough quarter, and as a result, our board decided to reinstate our buyback program with a commitment to buy up to $2 million of stock. Q3 was strong for signing new contracts, and were revenues and backlog to forecasting continually strengthened starting in Q4. That's again due to that sector diversification and the continued execution on our M&A strategy. As announced earlier this month, we announced the acquisition of a 24-person engineering firm based out of Houston, Texas. It's a synergistic and accretive acquisition for us. And not only have we acquired new contracts in CEA and commercial sectors, but we've expanded our team and we've expanded our team's capabilities. Further, we continue to hire. We have approximately 20 open positions right now, predominantly focused on the industrial sectors and engineers, architects, and construction management personnel. In closing, and to summarize our position today, our model is performing. We're continuing to build on it, and our vision remains intact. We will be the global leader in providing professional services and design build capabilities to the CEA sector. Our sector diversification, it's allowing us to focus on strong growth while our key sector, CEA, and more specifically cannabis, recovers. We anticipate this to happen by the Q2 of 2023, which time we'll be fully staffed, ready to handle the expected demand. We're properly capitalized to fund our plan. We're continuing to add expertise to our team, and we're targeting additional acquisitions to complement our continued growth. So with that, thank you for your time today. I do apologize, we're not going to have time to take live Q&A, but we'll welcome the opportunity to book one-on-one meetings with you, or you can reach out to investors at urban-gro.com and request additional information